Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar. Before we get started, please take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer. With that, D, good Monday morning, my friend.
Good morning, Will. How are you?
Good.
Good morning, everyone. Let me share my screen here. And today, what we'll do is cover how to bring up a historical options chain. And there are questions that I get, regarding that. How do I look up historical option prices? How do I look up historical performance of an option or even an option strategy? So what we'll do is cover how to bring up a historical options chain data. And we're going to give some examples of, what kind of data we could look back at and how do we observe or start analyzing some of this data. And we're going to use the data from our options chain. And to get to that options chain, if you type in the specific symbol in the search box, I'm going to just look up NVIDIA, and you'll end up coming to this summary page over here. And you have this menu to the left-hand side. And if you go under the options section, click on options. The first item here is options chain. And we're going to click on that. And this will bring us to, in this case, NVIDIA's options chain. And this is as of Friday's close. We're not open yet for this morning. This is still pre-market. So we're looking already at a historical options chain. But what if we want to go back further and take a look at how the option prices performed on a particular day? So I'm going to close this menu over here just to expand our screen. And now we're looking at a full option chain. You could see we have the different expirations here to the left-hand side to select from. And then when you select that expiration, you'll get the option prices, the calls, the puts, and different strikes that correlate to that expiration. If you click on one of these expirations, let's say we click on January 10th over here, we'll click on that, and this will bring up the January 10th expiration. And now we see the call to the left hand, puts to the right hand side, and the strikes are in the middle. So we could see the prices of the call, the bids and offers of the calls, the bids and offers and the puts, and then we see the implied volatilities for the bid, the offer of the call, the bid and offer of the put. Now, let's say we wanted to go back in time and look at a historical option chain and look at the prices and how they behave. And that's important just to study the dynamics of the markets, the option prices, how did things trade? Where were the prices maybe in the morning versus the end of the day? How did the prices change based on the stock behavior throughout the day? And if you're trading any market, doesn't matter if options, stocks, real estate, cars, watches, you have to know your market and how things behave, how things are priced, how prices change. So it's no different here. And one of those ways is to look back historically and observe, well, what happened in this situation. So here, just on this particular day, if we just stay on this day, we see that below here, we have different times, snapshots throughout the day that we could go back. Okay, this allows us to just go back in time, see at a particular time, how did this option chain look? Where were the prices, implied volatilities, and so forth. So even on the current day, we could go back in time, or we could go back in time dates. So if we, and you could see here that Friday's date was a shortened date because of the Thanksgiving holidays. We closed at 1 o'clock. So this is a snapshot right before the close, 12:59 p.m. And these are the different timestamps that we could go back by just clicking on one of these items. And below it, we see what the stock price was. So even if we scan with our eyes, we could see from 9:30, NVIDIA was 136.72. And then at 10 o'clock, it went up to 138.48. 10:30 was 138.68, and so forth. So it looks like it drifted higher and then kind of stayed around that 138 level, 138, 139-ish level. And if we kind of just wanted to see, like, okay, how did the options look like in the start of the day, we could click on this 9:30. And if we click on that 9:30 a.m., we get the options chain over here, 9:30 and 30 seconds, because you need some time for the options to trade. So we could see here that on this expiring, or we're on January 10th, this is what the options chain looked like at 9:30. If we wanted to go on the November 29th expiration, we could click on that. And then it'll bring up the November 29th expiration. And we see the prices at 9:30 and 30 seconds. So these were the prices, and these were the volumes at that time. So over here, these are the volumes in the call. These are the volumes in put. We see then on the left-hand side, the call bid, the call offer, the implied volatility of the call bid, the implied volatility of the call ask. And then on this side, we see the put bid, the put offer, the implied volatility of the put, and the implied volatility of the ask for these strikes. Okay. So looking at that, if we thought, okay, the stock price was around 136.72, and let's say at that moment we imagined that we were right, that NVIDIA will float up, and that maybe we even imagined that what if we were right on the direction and we did that the money strike? How would that look? So that the money strike was, let's say, 137, right? That's close enough to the 136.72. So the 137 strike in the morning was 54 cents, 55 cents. So how did that option look like at 12 o'clock? How did it look at 12:30? How did it look at 12? We could go and make, now that we have the historical data, we could go and look that up. So let's say we were correct and we decided that this was the 137 strike would have been the strike that we were interested in. So how did that look like at 12 o'clock? So if we click here at 12, so this is 12 p.m. So now we go to this 137 strike, and we could see here that it's 190, 195. Right? So you could see that it appreciated significantly. Basically, what this is telling us, if in the morning you looked at that at the money with the option that expires same day, and the stock did go up by, if you were right on that direction and by that amount, that appreciated significantly. We could see at the same time that put went almost to zero, 3 cents, 4 cents. So we could go back and say, well, what if we did that put? How much was the put? The 9:30. Go back and we could see that put was 82 cents, 89 cents, right? 82 cents, 89 cents. So you lost 80 cents on that put, and that would have been a little bit in the money as well. Keep in mind that if the stock is 136.72, 28 cents already in the money. That's why this put was more expensive than the call. So these are things that we could just start looking and analyzing, and we could look at the different scenarios, because if you're planning ahead, if you're strategizing and you're trying to like determine, different ways to strategize, and you have an outlook, and you might want to find a similar situation in history and see how that played out. How did the options look like in the morning, in the afternoon, by the end of the day? You have the ability here to use this historical data to look up and study those markets. Okay, and that's very important, because over the long term, you want to be the most informed, most knowledgeable trader out there. If you're playing, if you're playing chess and competing and stuff, you want to have the most information, be the smartest person in that room. So let's now take a look at it from a options chain that goes back in time. So this was going back in time the same day. But let's say we wanted to go and take a look at NVIDIA previous days. So over here, you have this historical options chain. You have a drop down to pick a date. And when you click on it, you get this different calendar. And you could pick a date on the calendar. So we could go back months. Okay, over here, go back years over here. But let's just say we want to go back a couple days. Now, Thursday, the markets were closed because of Thanksgiving. So let's go back Wednesday. So the prior day, trading day, would have been the 27th. I'm going to click on that, 27. And that is going to bring up now the options chain on November 27th. Right, so here we have the date, November 27th. So here, the November 29th expiration was still available, December 6th. All these expirations were available to trade on November 27th. You could see here that on November 27th, the 135 call closed 110, 111. But let's say even on this date, we wanted to do the same thing and say, well, how did this call look like at 9:30 a.m. or 10 a.m. or 10:30? We have down here the ability to go back to a different period in the day to observe those options. So how did the 135 calls, you could see they closed 110, 111 with the stock 135.32, but at 9:30 the stock was 134, right, $1 lower. So maybe a question is, if in the morning we chose that 135 strike with anticipation that the stock will rise, what did the option look like at 9:30 relative to the end of day? So let's click on that. I'm gonna click on 9:30. And this will bring up the 9:30 options chain. So you could see that what happened here. At 9:30, the option was 107, 109. By the end of the day, it barely appreciated, I think by, what do we say, like 2 pennies? So even though the stock went from 134 to 135.32, the stock increased by $1.30, like $1.30, right? Am I correct there? $1.30. So the stock increased by $1.30, and it went in the direction, if we bought that call, in the same direction that we were hoping. And it went from being, $1 out of the money to 32 cents in the money. So what gives here? Why did we break even on this basically? The option barely did anything, appreciated 2 cents. Here we'll look at it again. Went from 107 to 109. And we'll go back, right, where the stock was 134.01, right here, 134.01. Now we'll go to 359. So this is now the end of the day. So the stock is 135.32, and the option went to 110, 111. Basically, if you bought it for 109, you're not really, you're basically right there, appreciated by a penny. So what gives? Right? What's the deal with that? I bought a call, the stock went up, and I'm at the same place. Well, that's how you learn about the dynamics, right? What happened here? Well, one is that you had the days of decay. The option in the morning had more time premium than the same option at the end of the day, because now that whole days of trading is done, right? We from 9:30 to 4 o'clock, you have an entire days of trading, so you have volatility, but once the market closes, that day is done, right? So you have that decay now. You have that factor in the theta, the decay. The option has less days to expiration all of a sudden. So that's one factor. What's the other factor? Well, the implied volatility also. So you could see that the implied volatility in that call was 26.8, between 26.6 on the bid, 26.8 on the ask. So let's see where it started the day. So at 9:30, the implied volatility was 31.4 to 31.7. So you could see here that the implied volatility went from 31.4 to 26.7. So there are two things now that weighed on that option premium. Even though the direction, the delta was correct. So we got that right, but there's decay, and this option happens to have a lot of decay because it only had 2 trading days to go in the morning. So they decay faster, the options decay faster as you get closer, and the implied volatility came in. So now you got the implied volatility coming in and the decay that basically offset any of those delta gains, right? So that you ended up really just breaking even. That's the market dynamics. And another thing we notice here is that there's an implied volatility pump in that option. So you see where this particular implied volatility is a different color. It's white instead of green. Well, that's letting us know that something is going on in the offer, right? Something in the implied volatility on the ask side is different here than the other ones. That's what this is kind of getting at. And this is how you would look at it. If you look at the implied volatility skew, okay, if we look at the implied volatility of each of these options, right? So here's the implied volatility of these options. Usually, if you have a broker dealer, right? Let's say broker dealer is making markets. It could be a specialist, market makers. Their implied volatility curves will look smooth, not jagged. It'll be either sloping down, sloping up, maybe it could be a flat skew, but it's not jagged where you have one implied volatility higher than the next one, lower than the next one, higher than the next one, lower than the next. It doesn't, your distribution curve doesn't look that way. So here we notice something different, and that's lit up. That's what we call our IV pump. And the IV pump is saying, look, well, pay attention to this ask for now. And this is why it got highlighted. You could see that, look at the bid, the bid is 31.7, kind of going 31.4, going down 31.1. So in these three, you could see kind of trends a little bit lower. But here on the ask side, we don't see the same thing. We see it goes from 32.2 down to 31.7, back up to 31.8. So something here looks like there's a pump on the ask side. Basically, that there's some offer. It appears that there's like some offer creating some pressure, right? There's somebody wants to maybe sell it. There could be a resting order, or it could be a pump that's streaming with the markets, an implied volatility pump. We could also kind of see it based on the spread. So look at the option right below it, right? These are dollars apart. So you could see that the bid and offer on the 134 strike is 152, 155. Well, that's 3 cents apart. All right, so there's a spread of 3 cents. Those are the markets, the broker dealer markets, or the MBPO markets. And if we skip the 135 strike and look at the 136 strike, well, we see something similar. It's 72 cents, 75 cents. That's 3 cents apart too. So looking at that spread, right, you would think like, okay, if there's about 3 cents, we would be expecting something like 3 cents apart for that strike in between. But we see something different. We see that it's 107, 109. So it's only 2 pennies. So it looks like there's a price improvement, right? For that particular option, it looks like that the spread between the bid and offer is more narrow. The markets are tighter, more competitive. And it appears that the side that is narrowing that spread, side that is closing in, is from the offer, the ask side. All right, that's what it appears like with the surrounding markets. So at 9:30, what we noticed is that if we looked at it, that okay, there's an implied volatility pump, and if we looked at the other side on the put, we see that similar thing is happening in the put. Okay, it looks like an IV pump here. So there might have been some selling, a little bit of a selling bias in the morning already on that strike. Okay, now really quick, we only have a couple minutes, but if we wanted to just click on this strike here, on this call, I'm just going to analyze this call here. And once I click on the ask side, it brings up this populated ticket by November 29th call, 135, 109. I'm going to run this analysis, and it's going to perform all these different analyses, but what we're going to do is go to a historical chart. And let's say we just wanted to see how that option looked like different times of day, and just looking at the chart. All right, so let me see. I might be stuck here because I had this open for a while. But okay, so now we got all this different analysis down here. This is what the option price looked like throughout the day. Right, so this is going, from 9, you could see from 9:30, and you could see that it's come down, then going back up, and this is what the price chart looked like. But if we wanted a longer history, we could go here under summary and look up historical charts. And you could do this for a strategy too. So here you could see on November 27th, this is the range. We're looking at just November 27th right now. This is what the option did. Started over here. And you could see that it actually was even lower throughout the day. Went down to 30 cents and then kind of went back up to where the same price it opened, 110. At the same time, we could see, well, how did the implied volatility look like? So you could see the implied volatility started off higher and then gradually went lower throughout the day. And so why did that option come back? Implied volatility is obviously lower, right? So you'd think you're not winning on that if you're long. But you could see that the stock price below started out 134, went down throughout the day, and then the stock rallied and finished higher on the day. So whatever you lost in implied volatility and the time decay was made up, by the direction, the delta. And if you wanted to go back in time, you could go and use these same charts and just pick a different date and run the chart for that date. But we're going to stop right here, Will, because we're right up towards the end of our 9:30.
Yeah, that was awesome, D. As always, great start to the week with a very interesting webinar. Thanks for bringing that to the Market Chameleon community. Everyone have a great trading day. Great start to the trading week. If you're up in the lake effect regions with the snow, enjoy the winter wonderland you have up there. Great job, D, as always, my friend.
Thanks, everyone. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.